I am your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I am so excited today. We are going to be tackling a new topic. But while we are waiting for our guest, I know they are getting logged in right now. I just wanted to make sure that you are aware that we record this show live every Tuesday, so you can learn the ins and outs of passive investing. So you can go into your first or next investment with confidence. So if you haven't done so already, make sure to check out PassiveInvestingWithWhitney.com. There you can get a copy of my free ebook, Passive Investing Made Simple. You can also get a checklist with those steps as well, just so you can double check your own investment process. You can also get access to my calendar there. We can talk all things passive real estate and understand which investments might be appropriate for your portfolio. And Dan, you couldn't have arrived at a better time. You timed that beautifully.
Great.
Awesome. Well, guys, I am so excited today to have not only one of our managing partners on here today, Dan Handford, but to talk about a topic that I've been wanting to bring to this podcast for quite some time. And that is kind of the ins and outs of preferred real estate, just how we can navigate this current environment, because, it's different. Things are different than they were, 6 months ago, even a year ago. So Dan, I can't imagine anybody's listening in today and doesn't know who you are, but let's make sure everybody's caught up on the same page. Dan, welcome to the show. Would you just let everybody know what your role is here at PassiveInvesting.com and how you got into real estate in general?
Sure. So I'm one of the managing partners, as Whitney already mentioned, of PassiveInvesting.com. And my kind of role and focus here at PassiveInvesting.com is in the kind of investor relations, investor management, kind of overall marketing strategy, as well as kind of overall strategic objectives of the company. And so that's kind of where my skill set is and where I fit in here. And what also kind of goes really well with this is that my wife and I are also invested in about 85 different LP positions with about 19 different operators around the country. So, some of the content that we're going to share today is not necessarily have anything to do with PassiveInvesting.com. It really just has to do with passive investing in general, and the experiences that we've had, and some of the things that we've learned, and some of the lessons, and some of the different things that we've put into place to make sure that we're placing our capital in a good investment as we continue to vet different offerings that are out there.
Well, Dan, I know every time that we have you on the show, we always want to talk about those red flags because they're so important in just how investors can protect their capital. But I'm actually wanting to ask you some questions initially first about preferred equity, right? Because, as the market has shifted, I know a lot of investors that I'm speaking to on the phone are wondering if investing in debt is actually a better strategy right now, given where interest rates are and just mitigating the risk in the environment. And one thing that I like talking to them about is entertaining that preferred equity position. And I know we have some exciting things to talk about here specifically, but let's just start at the beginning. Let's help the investors here that are listening in understand what is a preferred equity position in real estate, and what are the different types of preferred equity positions out there, because you can't just say prof equity and wipe your hands and be done. There's just so many different kind of flavors of it out there. Can you help us understand that?
Yeah, and I guess we can kind of label this more of as preferred investing, right? Because there's preferred equity, but then there's also preferred debt, right? And one thing I want to make sure that we kind of completely get out here as well in the beginning is there is a difference between a preferred return and preferred equity or debt, right? So we don't want to get those confused. So preferred returns was not something we're talking about, but you would usually have preferred returns inside of preferred equity. But a preferred return can be done even if you don't have a preferential position in the capital stack from a preferred equity perspective, if you will. So one of the nice things about preferred equity, right? And when I say preferred equity versus preferred debt, is that you could do some more note investing and have preferred debt options as well. But then, for example, with our debt fund that we have right now, we actually have a real estate debt fund where even though it's a debt fund, you still hold an equity position in that company, and you're getting the first fruits of the profits from there up to a certain return, and that would actually be that preferred return and that preferred equity position. Now, when it comes to preferred equity, you definitely want to understand kind of where your position is in the overall capital stack, because you can still be preferred equity if there's 10 different people in the capital stack, or the cap table, if you will. Those that you might be in like the 7th or 8th position and still be considered preferred equity because you're way down the line, but you're ahead of other people, right? So you still have that preferential position in the capital stack. In most situations in real estate, what we typically see is you'll see the lender be down at the bottom of the capital stack as the most preferential person in the stack. Of course, that would be preferred debt, because they're going to get paid, that's going to get paid back first. And then you're going to have your equity positions, or your common shareholders, usually after that. And so usually it's an outside group, or or maybe sometimes we've actually done it where we've actually separated the class of shares, where you actually have a preferred share class. And the preferred share class, typically because it's a lower risk position, it usually has a little bit lower return, but it has a lower risk profile to it. And what happens is when that asset has income generated off of it, or when that asset is sold, that investor, as the preferred equity investor, gets their return before anybody else, and also gets their return of capital back before anybody else as well. So it's a very safe position to be in, or it's a safer position to be in. Let me correct myself there. And it also allows for you to have usually more consistent returns because of your position in the capital stack, and it allows for you to have that kind of preferential position, so that if for some reason the asset does go awry or whatever, your capital is much more protected than somebody else. Now, one of the things that you want to make sure that you look at when you're looking to place preferred equity is how much of the equity stack is coming from the preferred equity provider. And the reason why that's important is because, let's just say, just for ease of math, we have an asset that we need to raise and get 10 million of equity, right? Both preferred and common equity, to be able to acquire that asset. Well, you really don't want to go any more than about probably 30, maybe 40%. I'd probably say 30% is probably getting closer to the max of preferred equity in that position versus the common equity shares. And the reason why that's important is the more preferred equity you have, the higher the risk goes for the preferred equity, because then you have more people that are coming in, or more cash that's coming in on that preferred equity side. And the closer you get to that kind of 40% mark, it's going to start to kind of tip the scales, where the benefit as the preferred equity provider is not as much there. So typically what we like to see in a preferred equity position, if it's investing in a particular asset, is to see that the overall capital stack, if there is a separation of the capital stack, not being any more than about that kind of 30-40% range. We like to see it more like 20-30%. And so that's one aspect of preferred equity, is investing in a real estate asset where you're bringing in some of the equity stack, you're getting a cash flow payment, and you're getting the return of capital back before anybody else in the capital stack as well. So I'm going to pause there for just a moment. I know there's a few other things that we can kind of unpack here, Whitney, as we continue to dive into this. So I'll throw it back to you and see anything else that kind of maybe sparked in your brain a little bit. And your mute button's on there too, Whitney.
Thank you. Thank you for that too. This raises a couple questions for me, because there is, if you're and I know this was quite common in the past 2 or 3 years, we would see a multifamily deal, and there would be, in that equity position, a tranche A, tranche B. The tranche A would have just a cash flow return, no upside. In the deal, we called it more of a preferred equity position. But I also sense this, whenever you were saying you and your wife investing in other people's deals, that in a preferred equity position, you're kind of teasing out like, okay, where do we sit in the capital stack? Where, what are our returns going to be, but like, how are we protecting that return by making sure that equity position is reasonable for that particular deal? Now, I want to kind of, tease apart a little bit, because those are actually two different types of investments, really, right? And then there's also a third layer of investment, the preferred equity position, where people are, getting, back in, shares, in the GP, perhaps some voting rights. So there's all different flavors out here. What are you seeing? I think we can all agree that, understanding the preferred equity position, gives you a protection in today's environment, especially if you're looking for that type of protection in your portfolio. Where are you seeing this in relation, just with the market environment? Is this something that investors should be looking at right now? Who is the investor that this might be a good fit for?
Yeah. So this preferred equity, one of the primary things you're trying to do with the preferred equity position is not necessarily get a phenomenal return. The primary goal of it is to protect the capital, right? With the potential of having a decent return, right? But we're not looking for home runs with preferred equity. We're looking for very steady growth, right? But the capital is protected. And so in this type of an environment where we're seeing it right now, and it's actually something that we're actually working on here at passiveinvesting.com. We're actually going to call it our Alliance Fund, if you will. And so what we're seeing right now in the market is that there are people who have bought assets over the last 1 to 3 years prior to the Fed really raising a lot of their rates as fast as they did, and they're finding themselves in a hard position. So they've already at this point, a lot of them have paused distributions or even potentially done some capital calls. But now what's happening is it's been about 2 years now that this has come up, and most people purchase what is called an interest rate cap on whenever they purchase an asset with floating rate debt. And that helps to mitigate the risk for the lender because they want to make sure they're going to get paid, but it also mitigates the risk for the person who's borrowing the money. And so these interest rate caps in the past have actually not been that expensive, but now with the volatility that we're seeing, they can get pretty significant and pretty high. We've seen them into the multiple 7 figures before because of the state of the market that we're in right now. And what challenge that puts into these operators is that they have a decision that they have to extend their rate caps for the next 1 to 3 years to be able to continue to keep their property, because they can't refinance at this point, because if they have to refinance, the valuations are going to be lower, and so they might have to come to the table with more cash in order to refinance, and they're now going to have to be in a position where they have to do a capital call. And actually, they're in that position either way. So if they do a refinance where they have to come to the table with capital, or if they do an interest rate cap extension, they're going to have to come to the table with more capital to be able to continue to keep the property. And if not, what happens is the lender will now come in and actually foreclose on the asset, and it a lot of times wipes out all of the equity that the investors had in it. So all the investors lose in that situation. And so the opportunity that comes about for us is that we have the opportunity, if we can put together this fund that can come alongside some of these operators, and we invest in those operators. And we're not talking about assets that are like, highly distressed and poorly performing. We're talking about good quality assets where the asset is sound, the product is doing well, the occupancy is high, but the cash flows are hurting to a point where they can't afford their interest rate cap, and they don't want to lose the asset. Because if they don't extend their interest rate cap, now they don't have any cash flow to pay their mortgage, and so that's how that foreclosure could occur. And so being able to come alongside of these operators and say, hey, we're willing as our fund, we're actually going to call our fund the Alliance Fund. We're going to be able to come alongside you as a kind of a partner, and we want our equity to be in a preferred position. And then we also want, because we're helping you and saving part of your project for you, your investors aren't losing money, we also want to have a portion of the GP that is gifted to us because of this opportunity, because we're trying to help save the project for you, right? And so with the operators, they're more than willing to be able to give up a portion of their GP and say, hey, if you can help us with this, we don't lose our asset, we'll give you a part of the GP, and we'll also give you a preferred equity position so that really, we're going to get our money back first before anybody else. So, and again, there are certain criteria that we have to continue to control on our side of things to make sure that we're not investing inside of an asset that doesn't really have a very large capital stack. And I mean large capital stack. I mean, if we have an asset that has maybe $2 to $3 million in equity, that's not something we're going to really want to put our money in, right? Because we're looking at wanting to write equity checks between about $1 to $3 million for each one of these projects, and so we want to see probably $10 million or more in equity that is sitting behind us in the capital stack. So we're going to come in there and just insert ourselves in between the debt and the common equity and say, we want to come in here and help you save this project, save all the investors' equity, and allow you to buy that interest rate cap. Or it might be better for them to do the refinance, right? So whether it's a refinance or interest rate cap extension, if it makes the deal work, it makes it operate, and we can hold on to it for another 2 to 3 years and then sell it when the market has made a turnaround and cap rates have now compressed back down again. I don't personally think we're going to see cap rates compress down to where they were, over the last probably 2 to 3 years, at least not as fast as they did. But I do think we're going to see some cap rate compression as the interest rates start to drop over the next 12 to 18 months. And there'll be some opportunities for us to be able to exit some of those properties and see a great return for us on the preferred equity side, but also on the GP side. And when I say the GP side, I'm not saying that the GP side is just going to be for us, as the operator. We're coming alongside as the fund and saying, as the fund, we have these investors that we've brought onto the fund, and we want to invest as a preferred equity holder inside of the LP, but also the fund wants to have GP interest. And so the GP interest and the LP interest will both go into the fund and will benefit the investors inside of the fund that we've created to be able to create this alliance with all these different other operators. And I would say all these different operators. We're not talking about trying to do like a mass scale 30 to 50 operators, something like that. We're looking for a very select, like 5 to 7, maybe up to 10 operators that we can come alongside, that we know the operator well. They're a great operator, but they have an asset that's performing, and they also need some help from an equity perspective to keep that asset through 2024 and do this. There's a phrase out there: survive till 2025, right? And so that's kind of what a lot of people are trying to do is get through 23 and 24, and in 2025, especially with the presidential election coming up, I think we're going to see a lot of changes happening when it comes to the interest rate environment and just the economy in general as it gets closer and closer to the election.
Mm-hmm. Now, one thing that's really interesting to me, the way you described the Alliance Fund, and probably what's different for a lot of people that have been used to investing, say, like in an A tranche in the quote unquote preferred tranche in a deal, is that correct me if I'm wrong, there might not be all that say like the preferred return for that particular when you slide into the other operator's deal is, I don't know, 10%. I'm just throwing out a number. Then that might not all come back at once, so, what portion is cash flow? What portion then becomes the equity part of the deal? Or is it all like, how does it all break down?
Yeah, so a lot of it just depends on the deal that we're investing in, because I would say that for the most part, there's probably not going to be a ton of cash during the hold period, even as we insert ourselves in there as the preferred equity holder. But that cash flow gets built up. So we want to go in and of course we're going to be negotiating with these different operators with the best terms for us with our money, because obviously the person who's holding the check has the leverage, right? Because you need that money and we want to help you, and so we have to negotiate that back and forth. But in this particular Alliance Fund, there's not really going to be any cash flow per se. Now it is possible that some of these assets will start to spin off some of the return for us, which will help us with cash flow. But our initial projections is that we're not planning on doing any cash flow distributions unless the fund starts to generate some cash flow. Then of course we would, but we don't want to in our negotiations be pigeonholed into being required to have cash flow. So this type of a fund is one of those funds where if you have money, capital sitting on the sidelines doing nothing for you, or maybe in a money market making 4 or 5% or whatever, you can move this over into this type of an alliance fund, and you're not going to get any cash flow off of it during the hold period, but the goal of it is the future growth of it, right? So our target returns for this is going to be between like 20-25% return all in, right? And it could potentially go higher than that depending on our negotiating skills and getting certain positions in the capital stack. And there's also the opportunity for us to be able to not only ask for GP positions in the deal that we're investing in, but depending on the risk profile of that deal, we may also ask for GP interest in deals that are not even associated with that, but that are in that GP's portfolio to help mitigate some of that risk for us and allow us to get even higher returns for us in the preferred equity position. And so when we do our due diligence on an operator, one of the first things we do is we want to look at every single one of the assets in their portfolio, not just the one that they want us to invest in. That will give us a lot of clarity and information, and to determine how good is this operator, really, to be able to, for us to be able to be confident in being able to invest in that particular asset.
I love that, because to date, I think, especially, with the last 3 or 4 years, a lot of investors are used to getting that cash flow, that quote preferred equity tranche. But this is a different style of, preferred equity position, and still preserving, again, number one rule of investing, don't lose money, right? Not to say that the potential is not there, right? No investment is 100% risk free. But yeah, being able to take, that capital that might be sitting on the sideline.
Yeah, and one thing I would dovetail that comment on, Whitney, is that one of the nice things about investing in a fund like this is that you're not just investing in one of these opportunities. So if one of them doesn't perform as well as we're projecting, we have 5 to 7 to up to 10 other ones that are out there working for us that will hopefully make up if for some reason one doesn't perform as we projected, right? And so that's, again, another reason why it's good to invest in these types of funds that diversify across multiple types of opportunities like this, because it does create some diversification and does create some ability to kind of mitigate some of that risk by doing this in multiple different assets and operators instead of just one.
Well, and also something you said here, and correct me if I'm wrong, it would make sense that we're also shortening the investment timeline with something like this, right? Like if the asset was initially purchased, say like in 2021, and the time horizon for the business plan was, say, 4 to 5 years, we're coming in 2023, maybe into 2024. Now, maybe the time horizon has had to extend with the recent market environment, by a year or so, but we're coming in kind of midway point, right? Is that another way to kind of look at this as well?
Yes, that's a very good point to bring up. So, with the timeline aspect of things, like you said, a lot of these operators underwrite off of a 5-year hold time horizon. Let's just say right now it's going to be 6 years, right? Just because of the extra, year for the market and the conditions and things like that. Well, let's look at this and go, okay, we're coming in at, say, year 2 or 3. We'll have about 2 or 3 years left to be able to finish out that business plan. And so the goal of this fund is to be a 3-year or less fund, right? Meaning that, once we raise all the capital and it all gets placed, within 1 to 3 years, our goal is to have that money back in and return back to investors, because most of those deals, if not all of them, should be sold within the next 1 to 3 years, and for a nice, decent profit, so we can exit out as investors and from the fund.
Interesting. So with anything, there's somebody that this is for, and then there's somebody that this is not for. Is there any considerations if somebody, as they're evaluating something like this? I know we haven't released this fund, we don't have the full details in the deck to share, but is there, kind of the, as somebody's evaluating this, like pros, cons, advantages, disadvantages, and let's start with that question.
Yeah. So, the biggest thing I would say, even if no matter what type of an investment it is, if you don't have the money to lose, do not invest in anything like this, right? Because there is the potential to lose all of it. We try to mitigate that risk as much as possible. And, to date, we have never lost any investor capital, which is a great, notch on our belt, if you will. I about said on our shoulder, but that's a chip on the shoulder. We don't want that.
No chips.
Yeah, no chip.
Chips on the table, not on the shoulder.
Exactly. This is a good thing, right? So, but definitely make sure that that's a consideration, right? But I would say somebody who does not really need that capital right now, and you won't need it for the next 3 years, maybe even closer to say 4 or 5 years in case that we have to hold on to it a little bit longer. I would say over the next 3 to 5 years, if you don't need that capital for anything, but you would like to see it grow, and our goal again is to grow at 20-25% a year, that's a great investment opportunity for you, as long as you don't need cash flow, right? If you're retired or you need that cash flow to live off of, then this is not the investment for you, right? And I know you mentioned that this offering is not available. By the time some of you listen to this, it may actually be available. So our goal is to try to get it released by the end of this week. So this is actually Tuesday, the 26th of September, and our goal of 2023. And so our goal is to have that done by the end of this month, by the end of the month, basically, yeah, by the end of this week. So by Friday, we should hopefully have that released. So if you're not already on our Passive Investor Club email list and you have joined the club, make sure you go to passiveinvesting.com, and on the top right hand corner of the page on the website, there's a button that's a big blue button that says join the Passive Investor Club. So if you want to join that, you can certainly do that, and one of our investor relations team members will reach out to you, discuss your investment goals, and kind of make sure that you're the right fit for our group. But then you can be aware of that future offering that we will have available for the Alliance Fund, and be able to make a determination if it's the right fit for you. So.
Well, Dan, we have questions starting to come in. I like holding those questions for our Ask Me Anything session that we do after our recording. But before we go to that part of the show today, Dan, is there any last wisdom and thoughts, because we don't get you on here very often, that you would like to share with investors and how they can, navigate 2023 and beyond?
Yeah, I think we definitely, as investors, putting my LP hat on, we have to make sure that we're vetting operators and vetting them appropriately. I mentioned, we have a little over, my wife and I, 85 different LP positions, and so far to this point, we haven't lost any capital, right? I think we've had we haven't had any capital calls. There was one asset that in our portfolio that asked for somebody to invest from a debt perspective, but that was one asset out of 85. And so I feel like we've done a very good job of being able to create the criteria of who we're going to invest with and who we're not going to invest with, and we have vetted quite a few operators. And so that's actually, one of the things that we put together is that those red flags. And I think we've done a webinar on this with you before, but you can certainly go to our website, go to passiveinvesting.com/red flags, and get the article where we talk through these 8 red flags. It used to be 5 when we first put the list together. And then over the years, as we've continued to get more experience with this stuff, we've added on. So it went from 5 to 7, and then now 8. So there's 8 red flags that are now there for you to be able to review to, I look at it and say, this is kind of something personal for my wife and I. These are our 8 red flags that we look for. If any of these things are present, it's a big red X. We stop reviewing it and it's done. We don't want to invest in that particular offering or potentially operator. And if when you review this, you might look at this yourself as an LP and go, this particular one to me is not that big of a deal, right? So use that list of those 8 red flags as a guideline, right, for you to be able to have a starting point for maybe your own list of red flags. And maybe you have 20 red flags, maybe you have 5. But I think it's good to sit down and get to figure out what are those things, list them out, and that way when you're reviewing offerings, you kind of have a checklist. Does this particular operator and offering check these boxes and of yes or no? And if any of them are present, okay, we're not going to invest. We've made that decision ahead of time. And that way you remove the emotional component out of investing, because when you start to include the emotion part of investing, that's really when a lot of times you get in trouble, because you get caught up into that asset looks very sexy and cool and would love to have a 400 unit high rise building in New York City, right? And I saw a little notch on your belt again, right? But if it's a bad investment, no, you don't want that notch on your belt, right? So I know someone was mentioning here about the website again. So you can go to passiveinvesting.com and you do /red flags. It's all one word, red flags. I just typed it in here just to test it to make sure it worked. And it does still work. So you can go there and get that information as well. So.
Awesome. Well, Dan, as always, it's such a pleasure to have you on the show. Don't go anywhere because we have some additional questions coming in that I want to make sure we tackle. But for those of you who are joining us today, join our Passive Investor Club. If you would like to get future information on deals, especially, the Alliance Fund that is due to launch here very soon, or, you can also visit passiveinvestingwithwhitney.com and, hop on my calendar as well, and we can talk all things passive investing. Until next time, guys, we will talk to you soon.